June 22, 2020. The German stock market opens, and the share price of a company called Wirecard is falling so fast that the exchange has to halt trading. Less than a week later, the company files for bankruptcy. The stock, once worth over $24 billion on paper, is now worth almost nothing. The strange part is that Wirecard wasn't some unknown startup. It was a licensed financial giant, a global payments processor, and a favorite pick of investors who thought they were backing the next big thing in fintech. What happened next sent shockwaves through Berlin, Frankfurt, and the wider world of finance. As auditors finally started digging into the numbers, they couldn't find nearly $2 billion that were supposed to be sitting in the company's accounts. The money didn't show up in the banks where it was listed. It didn't show up in regulators' records. It didn't show up anywhere. The simplest explanation was the most terrifying. The money had never existed in the first place. The $24 billion company had built its entire empire on bank statements that were, in effect, printed out of thin air. So how do you build a company that size on numbers that don't add up? And how did the whole world let it happen for years? The story of Wirecard doesn't start with a regulator, an auditor, or a journalist. It starts with a man named Jan Marsalek, a young Austrian with big ideas and a hunger for control. In the late 1990s, Marsalek was working in the background of the European payments industry, moving between companies that processed credit card transactions and helped merchants accept them online. At the time, the internet was still in its early days, and digital payments were dominated by a handful of global card networks and a few big banks that charged substantial fees for every swipe. In 1999, a small German company called Wirecard was founded to sit in the middle of this system. Its job was simple: link banks, merchants, and card networks so that when someone clicked Buy Now online, the money flowed smoothly from card to seller. At first, it was just another back-end payments processor, invisible to the public, surviving on tiny margins per transaction. The early Wirecard was the kind of company that didn't show up on TV or in newspapers. It showed up in the fine print at the bottom of a website's terms and conditions. But Marsalek saw something deeper in the business. He didn't just want to move money. He wanted to control the narrative around it. By the early 2000s, he had positioned himself as a key figure in Wirecard's growth, slowly building a reputation for understanding the intersections of finance, technology, and regulation. He cultivated relationships with executives, politicians, and journalists, often projecting the image of a forward-thinking, tech-savvy bankbuster who could outsmart the old, slow-moving institutions. Over time, Marsalek's story became intertwined with Wirecard's story. The company wasn't just a payment processor anymore. It was a vehicle for a new vision of digital finance, a vision that sounded so modern, so bold, that questioning it felt like standing in the way of progress. The early 2010s were the decade that changed Wirecard from a quiet, invisible payments shop into something that looked like a real tech story. The world was finally catching up to the vision Jan Marsalek had been selling for years. Online shopping was exploding, smartphones were everywhere, and merchants, from small startups to global brands, needed a fast, reliable way to accept payments without paying the full weight of the old card networks. Into that gap stepped Wirecard, now rebranded in the public eye as a digital banking and fintech leader. The story investors heard wasn't about tiny transaction fees anymore. It was about revolution, a company that was building the invisible plumbing for the entire digital economy, processing payments across borders, currencies, and devices while quietly modernizing how banks themselves thought about money. Marsalek played a crucial role in that transformation. He wasn't just a technical operator. He was a storyteller who understood how to position Wirecard as the European answer to global tech titans. He surrounded the company with a team that spoke the language of growth, disruption, and network effects, and together they built a myth that was extremely hard to challenge without seeming out of touch. By 2015, that narrative had real momentum. The share price, which had crawled along for years, started to climb. The company claimed huge growth, especially in Asia, where it said it was processing vast volumes for Chinese merchants. The numbers looked too good to be normal, but the story was too compelling to question. The company appeared to be where the real growth in finance was happening. The only problem was that the story was starting to outpace the facts. That's when the first real crack appeared, but not from inside the company. It came from outside, in the form of investigative reporting that quietly began to pull on the thread no one wanted to see. The initial reaction to the Financial Times reporting was textbook denial. Wirecard's leadership, including Marsalek and CEO Markus Braun, dismissed the allegations as misinformed and biased. The company's lawyers threatened legal action. The story they pushed back was simple. Wirecard was a misunderstood, modern fintech under attack from the old financial world. For many investors, that argument worked. Wirecard was a licensed financial institution, a publicly traded company, and a major player in European payments. The very structure that made it look solid, banking relationships, licenses, global partners, also made it harder to believe the FT's claims. Questioning Wirecard felt like questioning the system that had allowed it to grow. Yet the story didn't die. The harder Marsalek and the company pushed back, the more attention it attracted. Journalists started noticing the gap between the company's narrative and the evidence on the ground. The complex web of third-party processors, Asian partners, and opaque revenue streams made growth easy to claim, but hard to verify. The real breaking point came when auditors and regulators started asking the questions that should have been asked earlier. They demanded not just documents, but verifiable proof from banks where Wirecard claimed to hold funds. The statements existed on paper, but the banks couldn't confirm the accounts. By 2019, the gap between the numbers and the reality was no longer a whisper, it was a shout. The $24 billion company looked less and less like a real institution and more like a carefully constructed illusion. But the final collapse still lay ahead. By June 2020, the illusion finally collapsed. Wirecard's external auditors refused to sign off on the company's accounts, citing missing documentation and unverified balances. The German financial regulator, BaFin, stepped in. Local prosecutors began examining the discrepancies as a possible criminal case, not just a technical mistake. The CEO, Markus Braun, was arrested. The founder and former top executive, Jan Marsalek, disappeared. Within days, the company filed for bankruptcy. The share price, once over $24 billion, evaporated. The story of the missing $2 billion became the headline, but the deeper truth was buried in the years before. Regulators, auditors, and the media had all been nudged away from the hard questions. Wirecard's executives projected the image of a tech-savvy, modern company, not a hollow shell with fake numbers at its core. The complexity of its operations, the global web of partners, and the opaque accounting made it easy to say, "I don't understand the details, but if the banks and auditors signed off, it must be fine." The Wirecard saga showed that a company doesn't need to be a tiny, shady startup to pull off a massive scam. It can be a licensed bank, a listed stock, and a media-friendly brand, and still be built on lies. The real lesson is the same one that appears in scandals like Enron and Theranos. If something looks too good to be true, the problem is often not the product, but the numbers behind it. The harder it is to follow the money, the more likely it is that the money isn't where it's claimed to be. For investors, consumers, and regulators, the takeaway is brutal but clear. The real safety net is not a brand name, a logo, or a headline-grabbing CEO. It's the boring work of asking, where is the actual money, and who can prove it? Without that, even a $24 billion company can be brought down by a single unfound bank account.